Investors Chronicle.
Welcome to another episode of the Investors Chronicle Interviews podcast. Today, we are very pleased to have as our guest Lord Lee of Trafford, an avid investor and the man widely deemed to be the UK's first ISA millionaire. He qualified as a chartered accountant, began his career by spending 2 years with a stockbroker before establishing a company specializing in M&A, which developed into an investment banking group. He was an MP between 1979 and 1992, and he's been a member of the House of Lords since 2006. In his role as a private investor, Lord Lee has written several hundred articles for FT Money and published 2 books on investment, How to Make a Million Slowly and Yummi Yoghurt, a first taste of stock market investment. He's also a patron of ShareSoc, the organization representing individual shareholders in the UK. Lord Lee, welcome to the show. It's great to have you here.
Thank you very much. And a reader of Investors Chronicle, if I may say so.
That's great to hear. That's great to hear. Let's get straight into it. Let's talk about your approach to investing and how it all began, really. You know, lots of things have changed over the years, over the weeks and months, you know, as always happens is in investing. But to go all the way back to the beginning, how did you start out in investing? How did you get interested?
Well, I suppose going right back, we're probably talking about when I was probably, I should have thought about 14. So that would be 1956. When my father, who was a doctor, he used to enjoy the stock market and put his modest savings into stocks and shares. And I used to remember him as sitting by a pile of stock exchange gazettes and Investors Chronicles, going through them diligently. Well, of course, Stock Exchange Gazette no longer appears, disappeared a long time ago, but the Investors Chronicle continues, and indeed I'm looking forward to reading mine this weekend. Anyway, I used to sort of pull his leg a little at him delving into these piles of magazines, and then I just started to sort of flick in myself, and that's really when my original interest started. And we used to get a newsletter as well by a chap called Beveridge. I think that came weekly or monthly, I can't remember. Which I suppose you'd regard today as a sort of a slightly more sophisticated tip sheet. And then there used to be something called the IC newsletter, which you got, the Investors Chronicle newsletter, which was around in those days. Anyway, I used to read this mix of publications. And when I was 15, 16, I bought my first share. I invested something like £45 in a company called Aviation and Shipping, who owned one ship. Unfortunately, the ship went down, and my £45 went down to the bottom of the ocean with it. So it was not the most auspicious of starts. But thankfully, things have improved a little bit over the years.
Yeah, absolutely. I mean, on that note, let's cycle forward a little bit and talk about ISAs in particular, and
Sure.
Your path there. ISAs began 1999 as the first ISA millionaire. I imagine you were very early investing in them.
Yes, well, we have to go back a little further, Dan, actually, to 1987, when PEPs were introduced, which, of course, really were the precursor to ISAs.
Sure.
And it was, I think, the Labour government, I think it was Gordon Brown, who changed the name and brought in ISAs. But to all intents and purposes, they were pretty well the same. So in 1987, it was Nigel Lawson who brought in PEPs. And I recognised fairly immediately that here was a great investing opportunity with the tax-free aspect that appertained at that time. But I've always chosen my own shares and never let anyone else do it for me. And so I wanted to try and find a plan manager who would allow me to choose my own shares. And in those early days, there were very few PEPs plan managers. And those that did exist really wanted you to choose shares from a particular list, which didn't appeal to me. Anyway, in the end, I managed to find, and I don't know how I did, Midland Bank Executor and Trustee in Sheffield, and opened a PEPs plan with them. And in 87 or 88, invested for the first time the maximum amount, which was then £3,000. And I remember buying into a company called Pifco, which was a Manchester-based electrical wholesaler and manufacturer. Ultimately, they owned Russell Hobbs. And for the first few years, I put in the maximum amount that I could, and also reinvested the dividends. So for the first 15 years, through to 2003, I think I invested probably a total of around £125,000. And the portfolio in 2003 was judged to be worth about £1 million. So that's how I became the first ISA millionaire, although whether I was, I don't really know. No one ever challenged me on that. And so, that tag sticks, as it were.
Yeah, of course you're right about the Pets, being the forerunner. And the reason I suppose I was interested in the 1999 year was partly because that's when the name changed, but also because that was, right before really we had a tech bubble, a bit of a market drawdown. So, how, we've had various events since then, of course, that we might come on to, but thinking back to that time, so how did you encounter that period? How did you deal with that period in your portfolio that had been growing through those years and still managed to reach $1 million in 2003?
Well, we've had a series of what I term left field or black swan events that have come along and hit me during my investment life. In the early 1970s, before we started with PEPs, we had the secondary banking crisis when shares fell and no one would buy, and blue chips were yielding 20-odd%. Then I remember, the secondary banking, not the secondary banking crisis, the subprime problems that we had in the early 2000s, and these events come along, and that's why, of course, there is always an element of risk in stock market investment, and you should never put all your funds into the stock market. You should always keep a certain proportion out. But it's in difficult situations. It is when you have a bear market that the greatest opportunities do actually arise. Assuming that you take the view that ultimately, we will get through this difficult period. If you believe that the end of the world is nigh, that Armageddon is coming, then I'm not sure what you do apart from maybe hide under the bed with a crate of whiskey and a bar of gold, or else climb the highest mountain and pray. So to be an investor, I think you have to be moderately optimistic that there is a future. And there's a saying that I noted very recently, which basically said that a bear market is when you make your money, when you make your profits, although you don't realize it at the time. In other words, yes. You're buying when prices are fairly low, and hopefully one does see a recovery. So when we've had these difficult periods, I've learned that it actually pays to buy and to be pretty fully invested. And so today, for example, with the stock market being relatively low and many small cap stocks of the type that I invest in really being very cheap and having been substantially derated, as far as I'm concerned, there are excellent buying opportunities.
Yeah, I was about to mention the current moment, but which we will come to very shortly. But perhaps before we do, as you say there, you are traditionally, or you are certainly known for buying and holding smaller companies and reinvesting dividends and what have you. Has that always been your approach? Has that evolved over the years?
As far as I can remember, I've never been a risk taker, and of course the secret of stock market success is really to avoid the losses. Everyone has successes and gets things right, but of course it's the losses that drag down the overall portfolio. And I equate it to golf, for example, where your things are going very well until the 17th hole or the 18th hole, and when you hit the ball out of bounds or into the river, as it were, and so the round and the card is ruined, as I know full well. So the key is to avoid the losses. Now, I try to avoid the losses by, first of all, going in or investing at a broad brush at a certain level when the company I'm investing in is already established, ideally is already profitable, and ideally also paying dividends. And I avoid startups, I avoid biotech stocks, I avoid exploration stocks, and I also avoid contracting businesses because they always hit bad contracts at some stage. Now, this is not to say that you can't make money from biotech stocks or exploration stocks, but they are for the specialist who focuses, in that sector or on those sectors. And I'm much more of a general practitioner, so I tend to avoid those. So I'm endeavouring to come in when the business is more established, investing in what I term proper businesses, businesses that I think are established, sound, have a board where hopefully there is significant director shareholding, where there is not too much debt, and where the company is paying the dividends. And over the years in my ISA, I have reinvested those dividends, and they've played obviously a very significant part in the build-up of the overall value of my ISA over the years.
You talk about these, established companies. At the same time, obviously, a lot of them, most of them are small cap still. So do you have a sort of a set level, whether it be in terms of market cap or in terms of turnover, that qualifies a company as established? I mean, it may depend on the sector, I'm sure, but do you look at set levels, or is it a case-by-case basis?
It's very much a case-by-case basis. Nothing is too small as far as I'm concerned, provided it's established and broadly satisfies my criteria. And also, I like companies where the team running it have substantial investments in it, as it were, and real shareholdings. So over the years, I've done very well in what I term proprietorial public companies, where essentially there is maybe family control or substantial family interest. And those businesses normally are fairly carefully stewarded by the generation of the family running the business, conscious of maiden aunts and similar who might have big shareholdings in the company but don't actually have an earned income. So the dividend is important to them. And while they want to move the business forward and expand it, they are conscious of the heritage and the business that they've inherited, and therefore, they don't take great risks and endeavour to build those businesses, at a steady pace.
Yeah, there's certainly a lot of good family businesses still in the UK market, or businesses with the roots in that structure. The small cap world, it is a big world though as well. How do you go about finding these companies? Do you have a method for that? Sometimes I suppose it can be quite serendipitous. As any investor would probably agree, you hear about something, it sounds interesting, you go from there. How do you
yes,
find
well, that's true. There is no set route. I mean, obviously, over the years, having been investing, for over 60 years, I pretty well know of every quoted company on the main market, as it were, and heaven knows how many I've invested in over the years, a huge number. As far as the AIM stocks are concerned, where I have a number of holdings with the particular taxation benefits that come from them, it's very difficult to keep up with a lot of the new issues that took place in recent years. So I'm not as knowledgeable of that market, but certainly of the companies that have been around for a long time, I'm very much aware of them. So I'd be tracking companies through Investors Chronicle, for example, through the City Pages. And then, I'm a member of a breakfast investment group and a luncheon investment group and a dining investment group. Thankfully, they don't all meet on the same day. Otherwise, I'd be even heavier than I am. Ideas are exchanged, and occasionally, I pick up an interesting one, which I will follow up. But generally speaking, in more recent years, I've much preferred to build up the holdings that I've got, where I know the management and have faith in the company, rather than sort of jumping about and over broadening the portfolio, and certainly not chopping and changing, because I believe that you only need two things for successful investment. common sense, and patience. And patience is the most important, and that's the one that most people don't have. And particularly, of course, with the development of technologies, and so you can have all your portfolio, on your mobile phone or on your iPad or whatever it is, and press a button and you can see immediately if you're making a profit. The temptation is there to take that profit, to move things, and that's precisely what you shouldn't do. And if I can put it crudely, there is an American adage which says, basically, you make your money by sitting on your ass. In other words, you get into something good or company that you believe to be good, and you stay with it. And you hope that company will grow and dividends will increase and its capital value will increase. I believe that's the way to make real money on the stock market. And obviously, I've had my successes, but I've also had my failures as well, as we all have. No one gets it right every time.
Indeed. On the number of companies you hold, then, were you implying there that that your portfolio has become more concentrated a little bit over the years as you tend to focus?
I would say so. I probably have. I don't know. It'd be difficult to say. Probably maybe less than 10, really significant holdings, and then maybe another 10 medium-sized holdings, and one or two smaller ones. And in more recent years, although I'm predominantly a small cap investor, I've also taken advantage of the very, very attractive yields, in my view, exceptionally attractive yields, which are available in the insurance sector, like Legal & General yielding dividend yield about 8%, and Aviva about 7.5%, and M&G, which is yielding sort of 9.5% to 10%. And these are extraordinary dividend yields, which I believe are maintainable. Indeed, with Legal & General and Aviva, they push the dividends forward each year. And within an ISA, of course, those dividend yields, tax-free, really do mount up significantly. So my portfolio at the moment, the ISA portfolio, which is my main one, is really, I suppose I've not worked out exactly, but it may be 2/3 small cap and 1/3 those large caps, which bring up the overall income.
That brings us on to the market as it stands presently. We've touched on it a little bit already, of course, but over the last 18 months, in this environment of rising interest rates, of course, you've been in the market for several decades, but have there been things you've learned or things that you've been reminded of over the last 18 months in particular? It's been a long time since we've been in a rising rate environment. How has that affected your thinking, if at all? What does that remind you of in terms of good investment practice in this kind of market environment?
Well, you talk about, obviously we talk about inflation and we talk about rising interest rates now, but I mean, I remember when interest rates, debentures were coming out at sort of 15% or so, going back into the 70s. I've always, frankly, tended to avoid and not over worry about the macro situation, unless you really believe that everything's coming to an end. And as I've said, I'm not sure what you do then anyway. I leave that to economists. I'm essentially focused on the individual companies and their performance. And of course, yes, obviously to an extent they're affected by the overall economy. But on the other hand, there are many small companies that can survive and grow in niches in the overall global economy, so one tries to find them. And I only invest in UK companies, but by and large UK companies that actually trade globally. So I have the advantage, I like to think, of UK governance standards, but at the same time, I hope those individual companies are seizing the global opportunities, and I'm sure they are, recognizing that the greater growth opportunities, lie in developing markets overseas.
And the UK market itself, it has been somewhat out of favor, albeit large caps less so last year and this year. You've spoken about the insurers a little bit. Those large caps and those yields are looking relatively attractive to add to the small cap part of the portfolio. But given what's happened with small caps over the last couple of years now. Taking into account the fact that you say, you're still sticking with your main holdings, that kind of thing, are you nonetheless seeing more small cap opportunities spring up that do meet your criteria and that are, interesting looking new investments?
Yes, I would say so. I mean, there's no doubt at all the market over the last 2 or 3 years has been quite challenging, and pretty well everyone has come down in value from their peak. And my portfolios, both my ISA, the main one, and the sort of non-ISA, which is of smaller value. They've all come down. But being very much a long-term investor, in almost all cases, I'm staying aboard, and as long as they're paying their dividend, which in the vast majority of cases they are, and indeed in some cases, most cases, or many cases, pushing dividends forward, as it were, I'm really quite happy. And I've seen some quite significant dividend increases recently. For example, companies like Cerillion, which I've done very well, which is an AIM stock, put the dividend up 27%, and Christie Group, which is also an AIM stock, dividend up 25%. So the dividend flow has really been extremely good for me, even though there has obviously been a drift in overall capital values. So, obviously one likes to see an overall higher capital value situation. And frankly, when you get to my sort of age and stage, the dividend flow is that much more important in a way, because it sustains one's lifestyle. It means one can help the family, and pick up the odd school fee bill and similar, and give a little to charity as well. So dividend income important, and the long-term capital value hopefully will take care of itself. And the other point I would make, and we've not touched on this, Dan, is that the whole pattern of corporate activity post-war has been very much the larger cap stock taking over the small cap stock. Yes. Now you can argue the merits of whether that's been nationally in our overall interest, but the fact is that when takeover bids do come along, they usually come along at quite significant premiums to prevailing prices. And we're seeing that at the moment. I've been on the receiving end over the years of something like 60 takeovers or take privates, almost all showing a profit on the then prevailing price. And I think also most cases on my original buying price. So those takeovers that come along, of course, do provide liquidity for the next round of investment opportunities, and so it goes on. So the combination of dividends retained and compounded within an ISA and takeovers from time to time has provided the liquidity to power the ISA forward.
Just on that point about takeovers, as you say, we have seen a lot. Certainly over the years, and certainly in the last couple of years as well. Do you have a general sense of how those bids are? It's very hard to generalize, I appreciate, but there's some suggestion that given the lowly rankings in the UK market, that some of these bids are a little opportunistic. It can be hard for a private investor, of course, to push back against that, given shareholding sizes. But how do you have a sense of the general type of bid coming in, and whether it affords the company the respect perhaps that it deserves?
Well, at the moment, there are a very substantial number of small public company, directors and chief executives who are tearing their hair out at the low levels of their shares, and in most cases, I concur with them. So you can argue that bids are opportunistic, and I know fund managers, for example, who have been approached to see whether they would sell holdings at a 25-30% premium to prevailing prices, and they've told the potential bidder to go away. They're not interested in selling out at that sort of level. So in fact, we haven't seen recently as many bids as probably one would have anticipated. I think this is partly the problem of raising debt finance to actually finance a number of these takeovers. But I've invested in many small caps often built up or controlled by an individual who reaches a certain stage where he or she really reaches an age where they want to capitalize on the business they've created. And therefore, they're looking to be absorbed or taken over, but of course at the right price. What we're seeing at the moment, and I've had two very recent examples of this with engineering company Goodwins, who are based in Stoke-on-Trent, and more recently with Ampario in natural stimulants for animal growth. Both those companies, which are relatively cash rich, have actually announced tender offers at higher prices to try and tempt weaker holders out. And in both cases, that actually has brought just something of a bounce in share prices. So I think we're going to see quite a number of tenders by companies to buy shares back, and with boards taking advantage of the low level of the market.
Let's turn now to private investing in general in the UK. From your point of view, perhaps with your ShareSoc hat on, what more should be done to facilitate and encourage private investing? You're obviously a testament to the successes that can be achieved through it, but there's plenty of people, who perhaps are a little bit reticent to get involved, or, have had their heads turned by other asset classes or cryptocurrency, things like that. From your point of view, what do you think are the big things perhaps that are missing from, the promotion of the use of private investing in the UK?
Well, I think that firstly, going right back, I think to early days, I think the financial education in schools has been lamentable. Quite honestly, it's marginally improving, but there's been so little, and so many young people leave school with so little knowledge, let alone of investment, but hardly any knowledge of budgeting or mortgages or deposits for houses or flats. So the education of stage one has been very, very disappointing. There's no doubt about that. And of course, we should all be, and governments particularly, should be very concerned that now there are more young people who speculate, and I use the word speculate rather than invest, speculate in cryptocurrencies than actually invest in more traditional forms of investment. So we haven't done a great job as a nation. Now, I think that both individual investors can be blamed to some extent, and also the companies bear a degree of responsibility, because I think that too many private investors are reluctant to approach companies, to pick up the phone, to try to talk to the finance director or the company secretary if they've got questions about the particular business, or go along to the annual general meetings to actually meet the board in person. They're not really prepared to, many cases, to make the effort. And on the other hand, the companies themselves, in my judgment, and this is obviously a broad brush comment, make very little effort to really build bridges with shareholders. And then another major factor, in my view, has been the total failure, I would say, yes, total failure of television, which has really been the dominant media into most people's houses, particularly those with money, slightly older people over the years. Total failure of television to promote UK companies, to talk about the successful UK companies. We've got many outstanding companies to talk about and promote. There's been no focus on investment opportunities, on how to invest. There's been a total failure of television, and it's a combination of, in my judgment, excessive regulation and reluctance of producers, for whatever reason, to actually focus in this area. And I think it's a tragic loss to the nation, and indeed to many investors. And we saw, for example, in recent years, people with cash in the bank, many people with cash in the bank, earning virtually no interest at all on their monies, on their deposits, and yet they could have invested in very solid UK companies paying 3, 4, 5%, let alone the 7, 8% that I was talking about earlier. When one was looking at the insurance sector. So companies, I think, could do a lot more. For example, I was debating recently with the Archie Norman of M&S, and he was talking about building bridges with shareholders. Well, as far as I'm concerned, if Marks and Spencer really want to build bridges with their shareholders, why don't they introduce a shareholders discount card? I mean, they, after all, have a normal shopper's card, and I've got one of those. I'm never quite sure what benefits I get from it, but you could easily have a shareholders discount card offering, say, 1%, a 1% discount, a very small discount, I agree, but one that nevertheless would encourage people to shop there and do more. And then you could have a series of regional meetings, and retail groups could do this, meeting in one of their stores, M&S or Next or whatever, in an early evening, and give shareholders who attend a small voucher, 15, 20, 25 pound voucher, as it were, to spend. You could do so much more if there's a will, but in my judgment, too many directors pay lip service to endeavouring to build bridges with shareholders, and they forget that at the end of the day, it's the shareholders who own the company. I mean, they're there as stewards, and obviously very important stewards for the period that they're on the board or running the businesses. But at the end of the day, the businesses are owned by us. And I think too many boards, frankly, forget that and regard the AGM as a bit of a chore. And if they can get away with having it at an inconvenient time in a city office and only 3 people come along, well, so be it, as it were. They think it's a bit of a waste of time, and it probably is if they only manage to get 2 or 3 people there. And then, of course, we've got this ridiculous annual report that now comes out, so that in the case of some larger companies runs to 270 or 280 pages, page after page of so-called risks that the business has, and all about LTIPs and how many board meetings individual directors attended. I think sadly, and I suppose I wear a little bit of a political hat as well, not necessarily party political, but I just think that we have now in this country, and of course there's the need to protect investors, although scandals still seem to appear. I think we are excessively regulated, and I think the regulation has stunted a lot of free enterprise and a market economy, and certainly it's had a negative effect on encouraging people to invest their savings in UK companies.
You raise a lot of interesting points there, and I think certainly in terms of the communication between companies and investors does leave a lot to be desired, and AGM season shows that, I think, again this year, which we've covered in our pages. And on the regulation point, I mean, this is a slightly different regulatory point, but there have been some moves recently to try and increase the attractiveness of the London market, both to all kinds of investors, but also to try and make things in life a little bit better for private investors. I mean, do you have an opinion on some of those proposed reforms? I'm thinking of things like, increasing retail investor participation in secondary issues, things like that. I mean, it's all good news on the surface, but is it enough in your opinion?
I think it helps, and we've seen the development of companies like Primary Bid, for example, which sets out and achieves to enable the private investor to participate. I think there is a tendency sometimes for companies and for the regulators to focus too much on the needs of institutions, and boards spend time with institutions, and less thought is given to the private investor. And we've really seen, although there are a lot of private investors in the country, there could be a lot more. And I come back to my earlier point, when we've got the last figure I think was about 5 million young people predominantly speculating in cryptocurrencies, where really, it's absolute gambling. They know next to nothing about it. I think it's very sad to see, and I think substantial change is needed, and I think we do have to lift regulations to some extent from people's and companies' backs.
I suppose, given the talk about the London market and the need, or the consciousness of the need for a solid domestic investor base, perhaps that will encourage people to pay more attention to the private investor, as well as, episodes like we've seen the last couple of years in the US, the power of those investors working together, albeit in some unusual situations. All this taken in sum, though, how do you feel about, the role of the private investor now? Do you think they're in a better place than they were, 10, 20, 30 years ago? On the one hand, there are a lot of these issues and problems which are perhaps going in the wrong direction. On the other hand, it is easier for investors to access information and to invest the right way if they want to do that. Is it possible to sort of weigh up the pros and cons of being? Well,
I think things have improved in two aspects, really. First of all, as you rightly say, there is much more information available on the web. On individual companies, all PLCs, pretty much all PLCs have a website that gives information. Regulatory news comes out 7:00 in the morning. I was personally look to see, what companies have announced early morning, and obviously particularly interested in any of the companies that I'm invested in. So I think the ability to access knowledge is greater probably than it ever has been, and that's a plus. And then, of course, we've had the development of over more recent years of platforms. Like the Interactive Investor and Hargreaves Lansdown and AJ Bell, people like that, where investors who don't want to take their own decisions and don't feel that they've got the time, then they should go there and obviously let fund managers invest on their behalf. Personally, I've always tried to encourage people to take their own decisions, and I think your average person, if they find the whole stock market of interest and apply common sense, will do, frankly, over the years, probably as well as most fund managers would do. And it's somewhat cheaper as well and more fun taking your own decisions.
Indeed. How do you feel about those platforms? And, do you have experience of using various different investment platforms? And do you feel they provide a good base for investors, or could they be doing more as well to help the private investor experience?
It's very difficult to know. I mean, I think they fulfill their role. I personally don't use them at all because I operate very much taking my own decisions as a traditional private investor, and I make my own arrangements in terms of visiting companies and endeavouring to meet up and talk to chief executives or finance directors of companies. Over the years, I build up a relationship, an awareness of the company that I'm investing in, and to some extent, of course, I suppose that can be slightly negative from an investment point of view, because you stay aboard a company for many years, and you feel that you're a bit of a heel if you sell and wave that company farewell. So I think I could be accused probably of being a little too loyal to one or two of the laggards, but there we are. Overall, I enjoy that relationship with the companies I invest in, and I hope most of them quite like having me as an investor, but who knows? Unfortunately,
we are running quite short of time, but I wanted to finish on a couple of broad thoughts of looking back. First of all, it's a popular question. It's a difficult one to answer, perhaps, but do you have in mind, when you think back about your investments, a best and a worst investment in terms of how well they did, or whether they surprised you for better, for worse, or something that happened along those lines?
You always get surprises, and sometimes you can anticipate, and other times you can't. I mean, currently, for example, I'm invested in a company called Videndum, the old Vitek business, who provide high quality company, providing all sorts of ancillary equipment for cameras and for the content creation sector. And the company was steaming along, well positioned, big growth in streaming and development of new studios. And then all of a sudden, along comes something called the Hollywood Writers' Strike. Now, I mean, I was never aware that there was an association of Hollywood writers who from time to time went on strike. Anyway, thousands of them have gone on strike. So all the streaming and productions in Hollywood and Los Angeles and what have you have come to a shuddering halt. And obviously, that's had a negative effect, certainly short term, on Videndum. Now, should I have been aware that there was a body called the Hollywood Writers? I suppose possibly I should, but what isn't. But in terms of looking back, I mean, one of my greatest successes has probably been with a company called Treat, T-R-E-A-T-T, which is my largest holding, and I've been a shareholder since about 1999, and it's done me proud over the years. And although the shares have come off, they've probably halved. There's been quite a substantial de-rating. I'm still showing a very handsome profit, and it's a company in flavors and fragrances. It's quite a unique PLC, and I think it has a very considerable long-term future. So I'm staying aboard. Looking back at one or two of them that have gone wrong, I remember being seduced by the high yield that HMV, if you recall, was offering. And then there was a complete collapse in the market for traditional vinyl records and the sale of cassettes, and they got in a real mess. More recent, of course, has been a resurgence in vinyl records.
Indeed.
But I lost money at that stage. And then before that, I remember there were three distributors of newsprint and magazines in the country: Smith's News, Menzies, and Dawson's, obviously reliant on contracts from the printers and publishers. And anyway, there was a particular round when all the contracts went to Smith's News and to Menzies, and poor old Dawson's got next to nothing. The business that was there pretty well disappeared to all intents and purposes. So, we've all had our failures, but of course, as I said earlier, the trick is to have far more successes than failures. Unfortunately, in more recent years, I think I've managed to achieve that.
Absolutely. On the subject of the written word, a lot of our listeners, I hope, like reading about investment as well. So as a final question, are there investment books or tomes other than your own that have helped you along the way, or that you sort of recommend to people?
Well, you kindly mentioned mine, and I won't repeat them. I think it would be taking advantage. I wouldn't say I've read too many investment books. I do read what I said earlier. I do read. I've always read the Investors Chronicle, and I enjoy the city columns of most papers, and endeavour to keep up to date. By that fairly light reading, I would say. And then obviously, if a particular company is of interest or appeals, then I can dig further into that particular business. But I don't spend hours wading through great tomes on investment, written by people who, in many cases, are rather long on theory and short on success.
Mm. The IC will suffice. Unsurprisingly, I feel that is a good place to end. But Lord Lee, thank you so much for taking the time to speak to us. I really appreciate it, and it's been great to hear from you and learn from your thoughts over the years. We hope you can join us again next time on another Investors Chronicle interview.